Imagine walking into a bank with a killer business idea. You've got solid revenue, good credit, a detailed business plan. You've done everything right. And then the loan officer looks at your application, looks at your name, looks at your face, and says, denied. Now here's the part that should make your blood boil. According to 2024 data from LendingTree, 39% of black-owned businesses were denied loans last year. 39%. Meanwhile, white-owned businesses, just 18% denial rate. That's not a gap. That's a canyon. And if you think that's just about credit scores or business history, I'm about to show you exactly why that excuse doesn't hold up. Today, we're exposing the racial bias baked into business lending. I'm going to share the shocking 2024 and 2025 statistics that prove this isn't paranoia, it's math. And then I'm going to show you how to fund your hustle without begging banks for permission. If you're a POC entrepreneur feeling stuck, feeling like the system is rigged against you, stay with me. Because it is rigged, but you can outsmart it. Let's break down the numbers. The Federal Reserve Small Business Credit Survey just dropped their 2025 report, and the disparities are worse than most people realize. Here's the breakdown by race. Black-owned businesses face a 39% denial rate. Hispanic-owned businesses, 29%. Asian-owned businesses, 24%. And white-owned businesses, 18%. Let me do the math for you. If 100 white business owners apply for loans, about 82 get approved. If 100 black business owners apply with the same qualifications, only 61 get approved. That's a 40% higher denial rate. Not 10%, not 20, 40% more likely to get denied just because of who you are. But it gets worse. Getting approved doesn't mean getting funded. White business owners receive full funding 58% of the time. Hispanic owners, 38%. Asian owners, 30%. And black owners, just 20% receive full funding. Let that sink in. Even when you get approved, you're almost 3 times less likely to get the full amount you asked for compared to a white applicant. And here's the stat that really exposes the game. The Consumer Financial Protection Bureau did a pilot study sending testers with identical financial profiles to banks. Identical. Same credit, same revenue, same business plans. The only difference was race. Lenders expressed interest in 40% of white applicants, but only 23% of black applicants. Same qualifications, 17 percentage point gap. You're not imagining it. The data proves it. Now let's talk about what this costs you in real dollars. University of Washington researchers found that black-owned businesses pay 3.09 percentage points higher interest than white-owned businesses. Hispanic owners pay 2.91 points more. Asian owners pay 2.88 points more. On a $100,000 loan over 5 years, that's an extra $15,450 just for being brown or black. That's not a fee, that's a racial tax. And across all minority businesses in America, this adds up to $8 billion extracted every single year. But the discrimination starts even before you walk into a bank. Let's talk about startup capital. Stanford research shows the average white entrepreneur launches with $106,000. The average black entrepreneur, $35,000. 3 times less money from day one. And outside funding? Forget about it. White startups receive an average of $18,500 in outside equity at founding. Black startups? $500. Not $18,000, $500. That's a 37 times gap in outside funding. And venture capital? Black founders received just 0.48% of all venture capital in 2024, less than 0.5%, despite being 13% of the population. So why is this happening? Let's expose the hidden scam. First, algorithmic bias. Banks love to say their decisions are objective because computers make them. But those algorithms, they're trained on historical data. Data that includes decades of redlining, discrimination, and wealth extraction. UC Berkeley researchers found that even fintech lenders, the supposedly unbiased digital ones, charge Black and Latino borrowers 5 to 9 basis points more on mortgages. That's $250 to $500 million extracted from minority borrowers every single year through quote unquote neutral algorithms. Second, zip code discrimination. This is redlining 2.0. The Department of Justice Combating Redlining Initiative has secured over $107 million in settlements since 2021 from banks whose lending patterns excluded the exact same neighborhoods that were redlined 90 years ago. Same neighborhoods, same exclusion, different century. Here's how it works. Algorithms flag certain zip codes as high risk. Guess which zip codes? Majority Black and brown neighborhoods. Every percentage point increase in Black population in a neighborhood correlates with an 18% decrease in high-speed internet access and a 12% decrease in online banking access. They're not just denying loans, they're denying infrastructure. Third, name discrimination. The CFPB literally fined Citibank $25.9 million for discriminating against Armenian Americans by targeting surnames ending in Ian and Yan. Supervisors instructed employees not to discuss these practices in writing. They knew. They documented it. They did it anyway. And here's the predatory twist. When you get denied by traditional banks, where do they steer you? Merchant cash advances with effective APRs of 35 to 350%. Goldman Sachs surveyed their 10,000 small businesses participants and found 37% of Black business owners experienced predatory payment terms. That's not an accident. It's a pipeline. Deny the good loan. Push toward the bad one. Extract maximum wealth. The system isn't broken. It's working exactly as designed. Banks have paid over $500 million in discrimination settlements. Bank of America paid $335 million in 2011 after minority borrowers were charged systematically higher fees. Wells Fargo paid $175 million in 2012, another $100 million in 2020, and there's still ongoing litigation because in 2020, Wells Fargo approved only 47% of Black refinance applications versus 72% of white applications. The gap got wider, not smaller. Let me tell you about some people who refuse to let this stop them. Janice Bryant Howroyd started Act One Group in 1978 with $900 from her mother, a fax machine, and a phone in the front office of a Beverly Hills rug shop. Banks wouldn't touch her. Today, Act One generates $1.1 billion in annual revenue, employs over 2,800 people across 19 countries, and serves 17,000 clients. She became the first African American woman to own a billion-dollar company. Her growth method? Word of mouth, baby. Community over banks. Damon John launched FUBU with $40 and sewing machines in his mother's house. He couldn't get financing, so he built a $6 billion empire through grassroots marketing, community support, and reinvesting every dollar of profit. No bank loans, no venture capital, just hustle. Tope Awotona, a Nigerian immigrant, self-funded Calendly after being rejected by dozens of investors. 30 million users later, his company is valued at $3 billion. Every investor who said no, they're sick about it now. These aren't anomalies. They're proof that when banks say no, the right answer is next. So let's talk solutions. Banks say no? Say next. Here's how to fund your hustle without them. Option 1. Community Development Financial Institutions, or CDFIS. These are mission-driven lenders specifically designed to serve communities that banks ignore. Their assets have tripled to $452 billion since 2018. 20% of Black employers now apply to CDFIs compared to just 6% of employers overall. Why? Because they actually approve people. And here's the thing. Urban Institute tracked over 22,000 CDFI borrowers and found their credit scores improved over time. These aren't charity cases. They're good investments that traditional banks are too biased to see. Option 2. Kiva. 0% interest microloans. Zero. Their loans go to 79% BIPOC borrowers with a 97% global repayment rate and 96% in the U.S. specifically. Over 73% of Kiva borrowers had never applied for a business loan before, and 52% went on to secure additional financing after their Kiva loan. It's a springboard, not a dead end. Option 3. POC-specific grants and accelerators. Goldman Sachs' 10,000 Small Businesses has invested $750 million and graduated over 16,000 entrepreneurs. 66% increased revenue within 6 months. 44% created new jobs. No debt, just education, capital, and connections. Google's Black and Latino Founders Fund has deployed over $50 million to 570-plus founders, with alumni raising over $590 million in follow-on funding. These programs exist because they work. Option 4. Bootstrap and build. I know it sounds old school, but here's the math. If you can bootstrap for 6 months instead of taking a predatory loan, you save 30% or more in interest costs. Every dollar you don't pay in interest is a dollar you can reinvest in growth. Start with a side hustle. Reinvest profits religiously. Use apps like Acorns for microinvesting to build capital organically. The goal isn't to avoid growth. It's to avoid extractive financing that traps you. Option 5. Crowdfunding with community power. Kickstarter, GoFundMe, Indiegogo. POC campaigns actually raise more from community support when they leverage cultural networks. Target 10,000? Aim for viral shares in your community, your family, your church, your cultural organizations, your social networks. These are your venture capitalists. And unlike banks, they actually want to see you win. Let me leave you with the big picture. Brookings Institution calculated what would happen if Black business ownership reached population parity. We'd gain over 680,000 additional Black-owned employer businesses, generate $776 to $824 billion in additional economic output, create 5.9 to 6.3 million jobs. That's not a dream. That's stolen potential. Every denied loan is a job that doesn't get created, a community that doesn't get served, wealth that doesn't get built. But here's what they don't want you to know. Cleveland Federal Reserve research found that Black entrepreneurial households actually show higher rates of return on their businesses than white households. Let me say that again. When Black entrepreneurs get capital, they outperform. The funding gap doesn't reflect ability. It reflects bias. You are not the problem. The system is the problem. And you can work around it. So here's what I want you to do. First, check out Kiva, cdfifund.gov, and Google's Founders Fund. Apply to everything. Second, if you've been denied a loan, file a complaint with the CFPB. They're actually going after discriminatory lenders. Make your voice heard. Third, share your story. Drop a comment below telling me about your experience with loan discrimination. We might feature your story in a future video. Your experience isn't just yours, it's evidence. And if this video opened your eyes to how the system really works, hit subscribe. I drop videos every week exposing the financial scams designed to keep us broke and showing you how to build wealth anyway. Share this with every POC entrepreneur you know. They need to see these numbers. Banks might say no, but your hustle? That's a yes, every single time. Let's build.